Hi, this is the RITE Report, April 16th, 2021. This is we do the approximately once a month. The RITE Report puts out a report on the condition of the stock market and the economy, and we're with Rick Samuelson. Rick is a venture capitalist on the West Coast. Good to see you, Rick.
And you?
And so the purpose of the RITE Report is to prognosticate the stock market 1 month in advance, and it comes out monthly. And so with this, we're going to go over the RITE Report and see what it portends for the month of April and early May. So the first thing that we do in the RITE Report is go over the macroeconomic snippets, news that hits each month, and see in what direction it's going. So in March, at the Bureau of Labor Standards, the real average earnings for all employees decreased 0.2%. And so we're going over the negative snippets right now, and also from the U.S. Census, U.S. business applications were down 13.4%. Bureau of Labor Standards indicated that real average earnings decreased 1%. U.S. retail and food service sales decreased 3%. Privately owned housing starts was down 10.3%. Manufacturing corporations' after-tax profits was down $6.3 billion from the third quarter. That's the fourth quarter. And from the Chicago Fed reported that decline in indicators related to production and personal consumption and housing fell 1.09, and from the U.S. Census, seasonally adjusted after-tax profits for retail corporations was down $8.7 billion. The U.S. Census reported sales of new single-family houses was 18.2% down. And from the Bureau of Labor Standards in 2020, multi-factor production declined at a 1.7% annual rate. New orders for manufactured durable goods decreased 1.1%. Personal income decreased 7.1% at a monthly rate, and the advanced international trade deficit in goods decreased. And new orders for manufactured goods in February decreased 0.8%. So we had 14 negative news snippets. And so now let's go to the positive ones. In January, sales of merchant wholesalers were up 4.9%. Average hour earnings increased 0.2%. Estimated selected services total revenue for the fourth quarter was increased 4.6%. U.S. total business end-of-month inventories were up 0.3%. Total business sales were up 4.7%. And the Conference Board indicated that while the recently passed $1.9 trillion fiscal support package will undoubtedly help the U.S. economy, many fear that it will result in a surge in inflation that complicates the Federal Reserve's extremely accommodative monetary policy stance. And these concerns, they state, are likely overdone. So pretty much they think that the 1.9 stimulus will help with the economy. From the Bureau of Economic Analysis, real domestic product increased at 4.3% in the fourth quarter. World merchandise trade continued to grow with a 2.6%. And after a decrease in the GDP that was caused by the coronavirus. Growth is expected to accelerate in the second half of the year, increasing by 2.2%. And they further expect it to increase in 2022 to 3.5%. This is a research place in the Netherlands. And also from the Netherlands, was that vaccination rates and in the Netherlands and other European countries will increase, and lockdown restrictions phased out, and as a result, the economy is expected to grow by over 2%. And the Conference Board Employment Trends Index significantly increased in March, and it's up now at to 102.44. Chicago Fed indicates that the end-of-month inventories were virtually unchanged, and the Conference Board U.S. Consumer Confidence Index rose sharply to 109.7, and and also from the BLS, total non-farm payroll employment rose by 916,000 in March, and the unemployment rate edged down to 6.0%. Pretty good. So the positive snippets are 14. So that makes it 50% positive and 50% negative. And so now we're going to go to the economic analysis indicator summary that we put together. We put together about 28 of these, and so the first one that we like to look at is the high yield bonds, and they went up, so that means the yields going down, so that's a positive. The iShares Select Dividend went up from 110.34 to 115 over the month, a beautiful increase. Purchasing Managers Index went from 60.8 to 64.7, so the economy is expanding. And the IHS Market Purchasing Managers Index also confirmed that, and it's expanding and indicating 59.1%. Construction spending was 0.8% down, so we're going to put that as a negative. Unemployment was positive; it decreased to 6%. So civilian labor force participation rate decreased, and the employment population ratio increased. So the employment trends index was positive. So 3 out of 4 positives. We give that a positive overall. And also from the BLS is that productivity decreased, output increased in non-farm business sector, and in manufacturing, productivity increased, output increased. 3 out of 4 increases, so we're going to give this a positive. And the quarterly financial report, after-tax profits were down, so that gets a negative. Retail sales came down, was a decrease of 3%, so the RITE report gave it a negative. However, it just came out, the current came out, and it was up for in April, so it just was too late to make this edition of the RITE report. But it was up drastically, and thus the stock market responded to that yesterday. The combined value of trade sales and manufacturing shipments was up 4.7%. Okay, so we give that a positive. And the all-important industrial production index put out by the St. Louis Fed downticked quite a fairly sizable amount. But just before this broadcast, it came out, the new one, and it is up So let's just take a quick look at that. So last month it went down, but it now ticked back up, and over the year. So this is over the year. So it's pretty much recovered now since a year ago, which was the depth, the nadir of the economy from the COVID fiasco. Over the 5 years, we take a look, and here's what happened last year, and it's recovered remarkably over the last year. So velocity of money upticked, and new residential construction was down 10.8%, so that's a negative. And the Conference Board, as was indicated in the snippets, the economic indicators increased, so that's a positive. And the coincident economic indicators had decreased from the Conference Board. Sales of new single-family homes was down 18.2%, so that's a negative. And new orders for manufacturing goods was down 1.1%. And the National Association of Realtors existing home sales was down 6.6%. The real GDP from the Bureau of Economic Analysis indicated 4.3%, okay, positive. Personal consumption expenditures were down, and personal income was down, and consumer confidence index increased remarkably, great. And the restaurant performance index expanded, and it broke the 100 barrier, which means the industry is actually expanding. I think that's the first time since in the last year. Corporate profits decreased, and new orders for manufactured goods decreased. World trade volume increased. So the CFNAI diffuse index, which is also a 3-month moving average, moved down. So we're going to give that a negative from the Chicago Fed. And the housing price index was positive, up 12%. So we got 12 positive indicators. 14 positive indicators and 14 negative indicators. So this is quite a dive from the previous month, but I expect it to rebound for the next report. So domestic political risk, we're going to now I make an investment strategy index, the RITE Investment Strategy Index, and we put domestic political risk as a -5 because Democrats have captured the control of Congress and the executive branch. Their campaign rhetoric indicates a preference for future tax increases, and which we'll discuss later in the show. But then the near-term plans seem to be centered on social justice and fossil fuel. So corporate taxes remain in place, so that's a positive. Although this may change, and we'll discuss that in a little bit too. Individual freedom regulations are likely to increase with the present administration, so we're putting that as a -3. And production of knowledge is because is way up because the government is investing heavily in research. And technical analysis of the market shows that the market overall is going up, and the business snippets are 50-50, so we put that as a 0. And the indicators are also 50-50, so we're putting that as 0. And so so our RITE Strategy Index rises slightly to 72.9%. So actually it fell. It must be it fell, I'm sorry. So it fell from 72.9 to 60%. And so here's the RITE Report summary. So in spite of the market suffering a devastating downturn from the epidemic, it is now recovering due to the positive business and economic news, along with positive developments in medicines, treatments, and vaccines for COVID-19. However, the RITE Report indicators decreased significantly this month due to only 14 positive economic indicators, and the RITE Report Index decreased sharply to 60%, possibly due to the unusually cold weather in the south this winter, and the price of oil has dropped probably due to Europe going into a temporary lockdown. And if this deterioration, well, although I shouldn't say that's when this report came out a few days ago, but oil has since rebounded, so it's actually gone close back up a little bit. So if this deterioration continues next month or in the following month, it could indicate a reversal in economic activity. But this deterioration is so far only 1 month long and probably due to temporary circumstances. So additionally, the Democrats are now only attempting to bring social justice to the forefront of their policy changes, and it appears that they do not have the necessary votes in the Senate so far, and we'll discuss this in a little bit, to change the tax laws which will allow the stock market to continue to advance. Thus, the RITE Report recommends to continue to stay long. Rick, what do you think? Stock market, should we stay long? What's your prognostication?
Well, I think the rotation trade out of tech and into the sectors that are obviously coming off of the COVID disaster. Oil, some of the best performing stocks so far this year have been in oil, industrials, and so forth. Tech has been generally performing much worse. I think those opportunities will continue to appear, and investors will make money on the back of that. I think that the overall stimulus is enormous. Once the infrastructure bill is passed, there'll be yet more stimulus. So monetary conditions will be kept loose for the foreseeable future. And under those circumstances, there's a base of support for the overall market that is very powerful. And this is a worldwide phenomenon, by the way, not just limited to the United States. So all of that supports for the foreseeable future, strong, well, I wouldn't say strong market performance overall. Within the stock market, certain sectors will perform very, very well. Other sectors will, like tech, will continue to struggle just because the valuations were so stretched, so ridiculously stretched. They're still ridiculously stretched. So there's plenty of opportunity to take money off the table there and put it into other better valued opportunities in other sectors. But I would say on balance, as you look out over the next 18 months, the risks are going to begin to outweigh what I regard as a relatively temporary stimulus package. People will receive their checks, they will spend that money, but unless they have a job that's paying more money, or unless they're, corporations are performing a lot better, the stimulus can only go so far. And those risks, as you cited, are first and foremost with respect to what taxes are imposed. We know more taxes are coming. What that final package looks like remains to be seen. The parliamentarian in Congress has a very a creative way of interpreting what a majority is and what legislation constitutes reconciliation versus legislation that requires 60 vote majority. So I'm concerned about that, and I'm also concerned about the increasing provocations from Russia and China, which will not discontinue. That is going to be a feature of the Biden presidency. They perceive him as a weak leader. They perceive him as toothless, and they're going to take advantage of that. And so we should expect to continue to see provocations in the Ukraine from Russia and provocations in the South China Sea from China, and the possibility of an invasion of Taiwan should not be overlooked. And that could upset financial markets very quickly and very devastatingly.
Would you predict an actual response from the United States were that invasion to happen?
I think the United States has very few options. The Chinese Navy is the largest, in terms of vessels, is the largest Navy in the world now. And it's all concentrated there. So our ability to oppose them in that distant location is very, very problematic.
So are you actually predicting that an invasion will occur?
Yes.
Got a time frame?
I think it's likely before the end of the first term of Biden.
Wow. Okay, so also I want to ask a question about, you mentioned, you referred to the infrastructure bill, and did you also mention that countries worldwide are printing money as the United States is?
Oh, yes, most definitely.
And so is this going to have an impact on inflation?
It depends really on whether that feeds through into wages. The problem all these countries have, with the exception of parts of Asia, is there's so much immigration into Europe and in the United States that wages remain and have remained for a long time artificially depressed. And right now we've got an administration that is stimulating immigration. So the scope for raising wages is, I think, really limited.
Now
it's really wage inflation that drives inflation.
Mm-hmm. Okay. And so you also mentioned that rotating out of present sectors into other sectors is probably going to present better opportunities for the investor. Would you mind to tell us what other sectors might be?
Well, anything to do with tourism, travel, those beaten down sectors like airlines and hotels, anything like that. It has really only one way to go, up.
Okay. Good point.
And some may not survive, but those that do, I think, are these kinds of assets are going to perform nicely.
Ah, okay, very interesting. Okay, thanks for that, Rick, and we'll see everybody next month in May on the next RITE Report.
Okay, thank you.